we would like to take this opportunity to get your views on markets in general. So there's a lot of noise that's going on around the global macros with the slowdown in developed markets, with Fed rate hikes, and now with the new fear of US debt ceiling talks kind of failing. So where do you see the entire global macro setup?
No, so let us put it this way. India and the world, our forex reserves in some manner act as a dam between the tranquility that is there in India and the volatility that is there across the world, including developed markets. Now, as long as our forex reserves maintain their levels or have a upward buoyancy, I think the degrees of freedom that our policymakers will enjoy will be there. And if you see the way interest rate increases happened, they kind of coincided with a period when our forex was depleting, and somehow it has again coincided with the period when our forex started to move up. Okay, and I dare say inflation, no inflation, what is happening in the West doesn't matter, but if a country loses forex steeply, the country will again have to increase interest rates to stop the bleed and maybe slow down the economy. So forex is the time. Now second thing is, yes, global growth being slower impacts our exports, and to that extent impacts our growth. Now what percentage of our economy is exports, and how much slowdown do we expect there because of slower global growth? And if we map it, it would turn out to be like 18% of our economy maybe export linked. If the world slows by 1%, 18 bips is the kind of slowdown that we will experience because of slower global growth. Now, today is a situation where you can't have both, faster global growth and lower commodity prices. So, my sense is if the world was growing more rapidly, oil won't be at $70, $75 range. It will be $85, $90 range. And, it will be like you get something from one hand, you give away something more from the other. And net all impact on the country won't be much. So today I am okay. I think it is good. Global is slowing down. Commodity prices are coming down. Inflation is coming down. It is great for a high growth country like India, where growth, like I said, export slowdown will result in an 18 bips shave off. That will then need to be made up from somewhere else. That was the export linkage. If you look at the Indian macros itself, inflation is coming down. Our policymakers avoided a rate increase last period. Growth, yes, will slow down versus last year, both nominal and real, from 15% nominal to 10.5% nominal this year, for example. But then there are spaces where the growth will continue. And my construct on the index is 18 and a half times 1 year forward. So if to 24 earnings you are taking at between 950 and 1000, I think we are at very, very defendable levels on the index with the outlook of earnings growth kind of compounding going forward.
Sure. And like you rightly said, now with growth fears globally, the commodity prices have started to ease off. And the other reason for inflation was also your supply chain bottlenecks. And those also seems to have been kind of behind us now.
Yeah.
With these things happening, some of the companies which are consumer facing, which are facing headwinds over the last 1.5, 2 years, do you see things changing for them?
No, so the consumer companies with pricing power have been increasing their prices over a period of time.
Yeah.
Now, if their raw mat cost goes down, clearly there will be an expansion in margins.
Sure.
And while it may be a tad unfair, but they do end up retaining a large part of it, and the market gives a multiple to that. I think some bit of that has already taken place. So if you look at a period between Jan and now, this part of the market has done very well, particularly in the month of March and April.
Sure.
Now, longer term, can it continue, especially the staples part of the market?
Yeah.
See, my thought is that in the journey of a country, as it moves from a lower per capita to a higher per capita, इसको कहते हैं रोटी कपड़ा मकान takes all of the mind and wallet share in the beginning, and staples come there, okay, but as you grow beyond that, they stay there. They can't just keep expanding their presence. So except for names hence, where premiumization can be a big part, I think rest of the staples will slowly fall behind. And I think to some extent you are already seeing it in the marketplace.
Sure. Both in terms of price correction and also the time correction that
both,
we have seen.
Yes,
for
absolutely.
the last
And relative performance versus the other space.
Sure. So in this backdrop, I mean, what are your preferred sectors, themes going forward?
Oh, sure. So what we did was to sit as a team, 9 managers, myself, Arya, Naveen, all in one room, and fleshed out narrow themes where the growth momentum can continue for a longish period of time. We are quality and growth focused investors. QGLP is the philosophy that we follow.
Yeah.
So to give you some example, number one was financials. We said we continue with banks which are retailish in nature, start to would have business as usual versus corporate bank. So what happens in a corporate bank is you lend to corporates and let's say working capital. Now if inflation goes down, the growth in working capital goes down because it's inflation linked, for example, and hence you have growth headwinds. Okay, versus that for retail it is business as usual. So we think retail-oriented banks will again start to do a tad better, relatively speaking, and which is what we have in the portfolios, and along with them, NBFCs who keep on adding newer verticals, which reduces the cyclicity of the business and provides a growth momentum. So that is on the financial side. Then coming down to, let's say, healthcare, which is a recession-proof kind of an industry. I think in that space, we are more glued down to hospitals and medicine retailing kind of infrastructure, because that is where an organized to organized play is super strong for one, and two, the need is very, very palpable. If you look at India as a country, yes, we are a very young country, but if you look at age cohorts of over 60 years, the growth that each of these cohorts will see will be way higher than any other cohort in percentage terms. So the need for this infrastructure is just going to be very, very high going forward. And during the COVID times when expansion slowed, the the actual profitability, the ROCs of the space became more evident, and I think marketplace is now getting clued there. And this is a space where inflation happens a tad more than the inflation in the country itself. So this is that kind of a space. So that is the other space. Then the third one, the big one, is consumption.
Sure.
Now, versus staples, which we spoke about, we are more with discretionary, mostly with high-end discretionary. So stuff like wedding clothing, stuff like premium shoes, jewelry is where we are invested, malls selling premium products, and maybe stuff like fast fashion. Where you companies have found a good and a fast growing space.
Sure.
So this is the other difference that we have versus other players in the high quality, high growth space. Now the next is technology.
Sure.
So on the software services side, which is like 11% of the index, We are less with the larger caps. We are more with the mid caps, which are focused in spaces which are still seeing strong growth. So travel, leisure, if you are European focused, then Europe is starting to outsource versus US, which is already way ahead. Then, autos, connected cars, electric vehicles, telecom 4G to 5G kind of a change and so on. So, businesses which are placed there have our interest. And yes, there are a few mid-cap companies who earlier were so small that they did not qualify in the larger size deals.
Sure.
Now some of them are crossing $1 billion, maybe $3 billion of size, and are qualifying in a more wider spectrum of deals, increasing their growth outlook. So that is where we are positioned. That's our. And in tech again, we believe new tech. This is a space where we are seeing businesses rapidly transitioning from losses on the EBITDA to break even over the next year and a half. One should see that. And growth runway is very long. We say these are good businesses, the valuations are still good. While yes, there will be volatility because of private equity ownership changes. These are broadly the large part. Other spaces where we believe growth will continue to be strong is engineering. So we have some exposure to MNC engineering companies, and defense. So that's a big theme in the country. And the other one which benefits from China plus one and now increasingly China plus one kind of an outlook globally is the chemical space. So, I have outlined to you practically all the themes that we are running with and believe that most, if not all, would do well irrespective of a slowdown internally or externally. And give ourselves, our investors, a very long runway of growth and order higher than that of the index, so that higher growth itself delivers some alpha to the clients after cost.
Sure.